Money in motion. Money in motion. Money is always moving in various places in the world, in every place in the world. And we're going to cover three key financial matters: ways to make money, ways to save money, and ways to preserve money. All right. Ways to make money investing in stocks and fixed income is what we'll start with tonight. So again, this is Koyfin. This is my brand new vendor, and I'm sorry, but I can take you to the important parts here. All right. When I am looking for a really strong growth stock, I'm looking for, believe it or not, a stock that has somewhat violent behavior. So look carefully at the screen. What you're focusing on is not the purple, orange, and yellow lines. Those are just the indices, the technology sector, the S&P 500, and the NASDAQ. This blue line, the faint blue line, is the performance of this quantum computing company. Now, I look at that and go, this is crazy to want to be investing in, but is there a buy point when there's a retreat? So that's a 5-year look back. So now I'm looking at just 3 years, and you can see it did hardly anything for 2 years and then started to wake up again because it had some emerging technologies, certainly tied to AI. It made a huge move up, came back to manage essentially a break even with the S&P and the NASDAQ, and then it shot up again. So I'm still looking for a pullback. All right. Well, here is just the current quarter to date. And now you can see that it's rocketed up again and has not yet pulled back. So now I take this to my risk management software, which is TradingView, and I can plug it in here, and you can see the red bar. We're on a buy once we exceed that level in late April. And then we have that pullback, and that's where we went in to buy it. So what is my point of showing you this? There are many different ways to invest, and I'm not saying my way is the best, but my goal with this segment, Money in Motion, over the next many years is basically to democratize what I've learned in 32 years so that you can use it yourself. And yes, that means you can use everything that I teach you and do this for yourself if you want to. It's okay with me. All right. I want to do my best in this segment, which will close every show, to show you what I've learned about making money, saving money, and preserving money. All right. All right. So that's what we're doing. Now let's go back to the show. Let's look at fixed income. So I just showed you a growth stock that would be appropriate for DS or CG. But if I'm looking for income in GI, I'm going to be looking first at the global yields around the world. Why? Because I want to know what I need to expect in a conservative investment. So this investment we're talking about is exactly the opposite of what I showed you the first time at Quantum. All right, so I start first looking at the different countries. All right, this is not quite G7, but close. US, Germany, United Kingdom, Spain, Italy. All right, China's in there. And then different durations, 1 year, 3 years, 5 years. So notice that the difference between a 1-year return in the US, 4.080, versus 10-year, 4.4, is not dramatically different. There was a time when this was like 300 basis points apart. So I have to have an inclination as to what the reasonable rate of return is in the way of yields and what I can expect to be able to put into a portfolio. And again, I know there's a lot of squiggly lines here, but all you have to pay attention to are the colored ones. And I promise for the next episode, I will have this figured out so I can project this better. But again, I just started with Koyfin. They're fantastic. Their data is just fantastic. Better than Bloomberg, in my opinion, and way cheaper. But at any rate, what you're seeing here are different rates compared to the dollar differential. So you have to take into account when you're looking at interest rates around the world, where's the yen trading, where's the euro trading, where's the Swiss franc trading, et cetera. And this allows me to look in multiple places just to get a sense of what I should be able to expect in the way of non-correlated returns. So we already have some treasury instruments in GI. I'm looking for something different than that that's not correlated to US Treasuries. So again, I can pull this chart, I can pull this data on this Schwab high yield ETF. All right. And I'm going to research this. I'm going to look at the returns on it. I'm going to look at the drawdown on it. You can see the gray areas where it pulled back. And in some ways, this will respond more closely to an equity than it will an interest rate. But I am looking at a return on this, an interest rate return over 7%. Now, if you remember the earlier part of the chart, there was nothing even close to 7%. So what I can do is see with the treasuries, which are going to produce probably around 7%, I can take a little bit of chance here. Now, I know you think GI is more conservative. It is, but I still need to take reasonable, concentrated risks in the fixed income area to get you that higher yield, because many of you that are in GI are expecting income from this. Okay. So that's what we're doing with this kind of investment. We then put that on the chart. We look for timing. You can see it's right up next to the breakout area. It actually ticked up there, and I bought this just earlier this week for GI. That's the anatomy of how you make money with stocks. And there are many ways to do this. And again, over the next several years, I'm going to continue to have this segment and show you that. So the second thing that's important for me to convey to you, again, I'm trying to democratize, meaning pass on my knowledge to all of you so that you can use this. And that's how to understand that poor spending habits get you in trouble. Here are 7 ways for saving money. All right. Don't spend money you don't have. That's not even on there, but that's a simple one, right? But look at this budget rule. So 50% of what your income is should be spent on needs like food, housing, insurance, etc. Only 30% on wants. Do not reverse those. And here's the most important one, 20% in savings. And I would argue that you want to get to the point where that 20% goes to the far left, and that's the first thing you do: funding an emergency fund, investments, retirement, etc. Number 2, the 1% rule for impulse buying. I love this. If the item is over 1% of your annual gross income, wait 3 days. That's a simple thing. It curbs impulse buying. Wait 3 days. If that item you're looking at buying, if you make $100,000 a year and this item costs more than $1,000, not $5,000, $1,000, just wait 3 days and make sure it's something you really want to do, or that it's returnable. Rule of 72s, I've talked about this for years. 72 divided by the interest rates is the years it takes for money to double. So in very simple terms, an 8% return, 72 divided by 8 equals 9 years it takes for money to double. Realize that and teach your children that, because it works the same for debt. It's just that you're probably not talking about a credit card rate at 7 or 8%. 72 divided by 18% means the debt doubles every 4 years if it just sits there on a credit card. Don't do that. All right. That's why this segment is so important. Money is always in motion, and it can be in motion going out of your pocket even faster than it goes into it. 401k match. If you've been listening to me for the last 20 years, some of you know I've said that many times. You should always, if you're still working, you got to have that match. 3 times your emergency fund rule. If you need $10,000 a month to live on, you need to have $30,000 in an emergency fund, because you don't know when an emergency surgery might happen. We just had one of those announced to us, and we're praying for the person, and good thing there's an emergency fund there, because that came out of nowhere. Now, I understand medical insurance kicks in, but there are co-payments and support that's needed after the emergency, after the surgery, I should say. All right. And then, of course, the rule of automation. Defaults are powerful because people are lazy. So if you want to be careful about this, if you are going to get subscriptions and going to keep getting subscriptions, don't, and I said this on my podcast earlier this week, I want to make sure, in case you're not listening to my podcast yet, you need to be. All right. If you're going to subscribe to something and they give you a choice of monthly or annually, don't do the annual, do the monthly. And didn't do the second month, maybe even the third month. It's okay to overpay for 3 months until you're sure you want it, and then and only then subscribe annually. That's what I'm recommending. And then finally, if you put an item in your household, take one out. You don't need stuff just, and this is a great way to not have to clutter up when you need to move, either at the retirement home or wherever you're going. Something comes in, take something out. All right. Give it away. It's likely that thing you're taking out you haven't used for years. Okay. That makes sense. All right. Money in motion. Money in motion. Now, ways to preserve money. I'll take questions from listeners from time to time. Please send me your questions, cb3 at cb3.com. Here's one from a listener. We said, how do I handle my mother's estate? Where do I start with the legal work, or do I hire a CPA? First off, I am not a CPA. And I'm not an attorney. I'm never going to give you advice in that area. But what I can tell you is first determine if the estate must go through probate. If your mother, and that's answering this question, had a living trust and transferred her assets into it, you might be able to avoid probate. That would be fantastic. If not, you'll need to file the will with the probate court and notify creditors and agencies like Social Security. So opening an estate bank account is essential. I can't stress that enough. You need to open a bank account. If you're going to have a trust, you can't just create it on paper. You've got to have a bank account associated with that. And likely you'll be retitling your investment accounts too. Again, I am an investment advisor, but I'm not a tax advisor and I'm not an attorney. But just pay attention to what I'm saying here. If you're in this situation or you know someone that is, at least be aware of this very basic thing. Are you going to have to go through probate? Preferably, you do not go through probate, or it's a very simple probate because all the assets have been placed in trust. You stand before a judge and say, Your Honor, there are no untrust or non-trust assets. They're all in trust. The judge will hit the gavel and say, next. And that's what you want to hear.